We're doing a series to start the year off right called 25 Things to Consider in 2025. And the first thing to consider, make sure that you review your beneficiaries on your IRAs and your 401ks at work. Life changes, whether it's birth, death, adoption, divorce, marriage, those sorts of things. Make sure that who you have listed as your primary and your contingent beneficiaries on your retirement accounts is accurate, because should you pass, whoever's listed on those accounts is going to receive the money. So make sure you get these things updated. Do it now. The second thing you should think about doing is use any unused $529 and make Roth IRA contributions for your kids. Now, a couple of rules apply here. You have to have owned the 529 plan for at least 15 years, and your kids need to have earned income, get a W-2 from having a job. But as long as those two criteria are met, you can use any unused dollars in the 529 plans to help your kids get a great start in life and save in a tax-free bucket, the Roth IRA. The third thing for you to do is make sure that you have named contingent beneficiaries to all of your IRAs, Roth IRAs, and 401ks or retirement plans at work. We all know that we should name a primary beneficiary, and that's who's going to get the money if you die. But what happens if you and the primary beneficiary die at the same time? I know it's morbid, but think about car accident, plane crash, those sorts of things. By naming a contingent beneficiary, it will ensure that your money goes to the people who you want it to go to. So go review all of your retirement accounts. Make sure you've got a contingent beneficiary named. Do it now. And the fourth thing I want you to think about is adding a successor beneficiary to any inherited IRAs that you may have received from a loved one who's passed along and given them to you. So we all know that we need to name beneficiaries. By putting a successor beneficiary on your inherited IRA, it will ensure that your IRA gets to the person that you want it to go to after you pass. This is a really important detail that you got to make sure you don't overlook. Go take care of it now. And for our fifth thing, if you're between the ages of 60 and 63, make sure to take advantage of the super catch-up contribution on your 401k plan. This allows you to get in an extra $11,250 to your 401k plan. It's new for this year. It's going to allow you to really save a lot of money, lower your tax bill in the process, and help to build wealth over time so you can retire in style. Our sixth item to consider is make sure that you review your distribution reporting. So any distributions that you took out in 2024 from IRAs, 401ks, from your taxable accounts, anything that's going to give you a 1099, which should be arriving in the middle of February, make sure that you cross-check what actually happened in 2024 to the 1099 information and details that you're going to receive in February. Mistakes are not uncommon. And remember, there's tax consequences for these activities. So make sure that the information on that 1099 is accurate so you don't overpay your tax bill. The seventh thing I want you to do is double check your year-end statements for accuracy. So all of your IRAs, your Roth IRAs, 401ks, any type of investment account that you have, check that year-end statement and make sure that it was as accurate as it should be. Also double check that your contributions and your distributions were accurate, because again, sometimes mistakes can happen. I want to make sure that you spot it and you're not caught off guard. The eighth thing I want you to think about is making a Roth IRA or traditional IRA contribution for 2024. It's not too late to get a contribution in for last year. You have until April 15th of this year to make the contribution for last year. So if you qualify from an income perspective, take advantage of the next 3 months here, get the contribution in for last year. Your future self will thank you. The ninth thing I want you to think about is go ahead and make a contribution to your IRA or your Roth IRA now. Don't wait till the end of the year. Go ahead and make the contribution now and get your money working hard for you, get it growing, get it compounding for you, and start to build wealth. So invest early, invest often, and make that contribution now. And the 10th thing I want you to think about is take advantage of the catch-up contributions for your IRAs, your Roth IRAs, your 401ks, your health savings accounts, your HSAs. If you're over the age of 50, the IRS allows you to contribute extra money into your IRAs and your 401k plans. go ahead and do that because it's going to help you lower the tax bill and also build wealth over time. If you're over the age of 55, you can also take advantage of the catch-up contribution for your health savings account, your HSA. So make sure that you are getting the extra contributions in because it's only going to help you down the road. And the 11th thing to consider is make sure that you avoid making an indirect rollover of any qualified accounts. So if you leave a job or if you transfer an account from one custodian to another, make sure you follow the rules and do it the right way. Make sure you do a trustee to trustee transfer so it's not coded as an indirect rollover, which ultimately can cost you from a tax perspective. So know the rules, do the trustee to trustee transfer, and save money on taxes by doing it that way. And the 12th thing for you to consider is make sure that you don't lose your cost basis when you transfer your taxable or your non-qualified account. What I mean by that is the cost basis is the price that you paid for whatever investments you have in the portfolio. And if you're going to transfer your account from one custodian to another, make sure that the cost basis or your purchase price also transfers over to the new custodian. This is going to help you in the future when you sell investments or when you rebalance your portfolio. It's going to help for accurate reporting, which ultimately is going to keep that tax bill lower. So having accurate cost basis information is super important. Make sure it transfers over with you if you move your accounts this year. The 13th thing for you to consider is to check a form 5329, which is the form that's used if you take an early distribution and there's a 10% penalty or there's a 6% penalty for making excessive contributions. This is the form that you're going to need to file in order to basically admit that a mistake had happened and to follow the appropriate steps to stay out of trouble. So you got to know the rules. So do your research on the rules, but it's form 5329 that's going to be used to report any sort of early penalty and that sort of thing. So know the rules, use the form, stay out of trouble. The 14th thing for you to think about is if you're turning 65 this year, make sure that you sign up for Medicare 3 months prior to your 65th birthday. There is a window of time with which you can sign up. And if you delay too long after your 65th birthday, there could actually be penalties that are assessed, and those penalties will stick with you for life. So ideally, sign up about 3 months prior to your 65th birthday and don't get hit with that penalty. The 15th thing is make sure you're clear on when your required minimum distribution begins. So the required minimum distribution, or the RMD, is the amount of money that the IRS forces you to take out of your IRAs or your 401ks. And if you were born between the years of 1950 to 1959, your RMD beginning age is 73. If you're born 1960 or later, your RMD beginning age is 75. So make sure you know the rules and you know when your RMD needs to start. And the 16th thing for you to think about is if someone in your life dies this year, terrible subject, but it's important to know the rules. If someone in your life dies this year and they needed to take a required minimum distribution, make sure that the RMD does get satisfied by December 31st, 2025. So hopefully no one's going to pass in your life, but if someone does die and they do need to be taking, or they are taking required minimum distributions, you got to make sure that you keep your eye on the ball and you get that RMD done before the end of the year. And the 17th thing to consider is make sure you know, for when it comes to an inherited IRA, you've got 10 years to take all the money out. And there's some really specific rules around this. Make sure you understand the new 10-year rules, how they work and how they apply to you, so you can avoid a huge ticking tax time bomb. And the 18th thing to consider is make sure that all 72T distribution payments are made before the end of this year. So substantially equal payment amounts, or 72T distributions, are what people use to access their IRA money or their 401k money before the age of 59 and a half. So if you're doing these, make sure that you keep up consistently and you do them so you follow the rules and you avoid a penalty. So get that distribution completed by the end of the year. And the 19th thing for you to consider is that if you're going to do a Roth conversion this year, it's not a bad year to do it. The 10%, the 12% tax brackets are still around. They're really low. And if you find yourself in the 10 or the 12% bracket, strongly think about doing a conversion. But if you do, make sure that the conversion is completed by December 31st, 2025, so that it's coded for 2025 when this year's tax code applies. And the 20th thing for you to consider is think about doing a QCD, or a qualified charitable distribution. If you're over the age of 70 and a half, you can do well by doing good by making a distribution directly from your traditional IRA right to the charity of your choice. And by doing that, it will avoid you having to pay taxes on the distribution. So you could make your donation or your tithe or your gift to the charity of your choice if you do it correctly using a QCD, and you can do up to $108,000 of QCDs in your lifetime. The 21st thing to consider is if you're going to use the net unrealized appreciation strategy, or NUA strategy, in 2025, make sure that your employer-sponsored plan has a zero balance by the end of 2025. It's a great way, it's a tax play, it's a great way to save money on taxes if the situation lines up well for you. But if you're gonna do it, make sure that the 401k plan is emptied out by the end of the year. The 22nd thing for you to consider is make sure that all of your after-tax accounts are titled correctly. So if you're married, you really need to have a trust account. So have that account registered as a trust. If you're single, consider putting it as a transfer on death account, where you can name a primary beneficiary and a contingent beneficiary, so those assets avoid probate should you pass away early. And if you inherited the money and you live in a community property state like ours in California, make sure that you consult with your estate planning attorney to talk about the proper titling of that account so you don't commingle it if you want to protect the assets. And the 23rd thing for you to consider is that if someone in your life passes and you need to set up beneficiary IRAs for the beneficiaries, make sure that those accounts are set up by December 31st of this year. Basically, get the accounts opened up before the end of the year. These are going to be subjected to the 10-year rule. So all the money needs to be taken out of those inherited IRAs after 10 years. And it's 10 years from December 31st, 2025. So get those accounts set up by the end of the year. The 24th thing to consider is make sure that any capital losses from the past are carried forward into the future. So if you did any tax loss harvesting last year in 2024, 23, or in particular 2022 during the bear market, make sure you've kept careful records of those tax losses and that you're carrying them forward so that in the future, when you rebalance or you sell anything at a gain, you can offset those gains with the losses that you carried forward from the past. In this way, you can be really tax efficient with your investing. The 25th thing for you to do is check and make sure that you don't have any old 401k plans that are hanging out there that you're not aware of. Or maybe you are aware of them and they're small and they're just kind of doing their thing and you think you're diversified because you've got lots of different accounts in different places. This is the year to get organized. New year, new you. Start the cleanup process. You're going to create more efficiency. You're going to reduce overlap and waste. You're going to reduce expenses and overall get a better investment experience for your accounts.